same day. You can. You don't have to say it, tell anybody. You can do whatever you want. You close them whenever you want. You still have to have the leverage, because you're using leverage. You have to have at least the value of the margin in your account. In other words, if you were trading X, Y, and Z stock, you had $1,000 in your account, and you purchased $10,000 worth of X, Y, and Z stock, but X, Y, and Z happened to fall, and it fell down $10. Well, you wouldn't have to pay anybody, but you'd have to have that amount to cover that loss, which isn't taken from you, in your account, because you had the $1,000 for the leverage, and you have to be whole at all times. So you had to have that other $1,000 in your account. But because the market goes up and down, up and down, up and down, it's got to go more than the $1,000 margin that you had. And then just as long as the money is in your account, it's not taken from you. And the margin, the down payment, the cash requirement isn't a fee. Imagine it's like you're buying a house, and you go to the bank and say, I'm putting down $100,000 on $1 million house, and I want a $900,000 loan. Now, this isn't a loan, but you're putting down, you're putting down the $1 million on that. You're putting down the $100,000, financing $900,000 for a total of the $1 million for the house. When you sell the house, you get your $1 million, and you pay back the $900,000. You get your $100,000 back. There's no cost for it. So keep in mind, it is not a fee that is charged you. It is simply a down payment deposit. Okay, so let's get on with price never lies. Now, I've been trading since, I mentioned before, since the 70s. Things have changed a great deal since then. We didn't have computers. We didn't have advanced charts. We didn't have news services. We didn't have economics calendars. The world moved at a lot slower pace. So today, everything moves a lot faster. And I believe in one hardcore, well, actually three adages. Number one is that price never lies. Price is price is price. Whatever the price is on a chart is the same price on your chart as it on my chart as it is a chart across town. And that is all that you know for sure is the price. That's it. Then my other belief is that the market is completely random, because it's made up of millions of human beings making personal decisions and trading decisions all around the globe. And these decisions are affected by lots of things. So it forces the market to be random. But at certain times, the market exhibits non-random behavior. When we see this non-random behavior, we can then apply a lot of decision making to determine when to enter the market and when to exit the market. This non-random behavior is translated into what we call trends. Okay. And my third belief and my third adage is always trade with the trend. Now, when you get the price action is a method of what we're going to call day trading. Okay. Day trading isn't what we talked, you saw in commercials on TV, 20 years ago with somebody sitting on a beach with their laptop, counting their all the money they're making. Nor is it the guy leaning against a Rolls Royce telling you he got rich. Okay. Day trading is very, very difficult. Okay. A lot of risk, a lot of attention, a lot of demands. Very few people are successful, but very few people are successful in anything they choose. But hard work pays off. But with CFD trading, there is no way to describe CFD trading, because a day trader, okay, when I started trading many, many years ago, you had to ask a broker and announce that you were going to be doing day trading. And that was a specific type of an account, because day trading has one rule: every trade must be closed by the end of the trading day. And so this becomes a big problem for most traders, and especially for CFDs, because CFDs don't have to be closed by the end of the day, and you don't have to announce to your broker or have a special account set up for day trader. But there's no other word that I can use, because with CFD trading, you can allow that trade to roll over every night. If you want to keep a trade open for 2 weeks, you can. There's nothing, nobody you have to tell, nobody you have to ask. But we all get this image in our head of day trading. They're relatively short-term, fast trades. And that's what CFD trading is. Now, price action trading is a method of trading where the traders make decisions about trades based on price movement rather than on indicators derived from technical analysis. We could call it chart trading. Now, there are many different strategies available for traders to use. Some are easy, some are complicated, but ultimately it requires you using your eyeballs and getting to know the personality and seeing what price is trying to tell you. Price action trading is a strategy based on the movement of prices rather than indicators or analysis. There are many different price action strategies you can use, such as candlesticks or breakouts. While many traders use price action trading, it's still not one size fits all. You should practice trading before trading with real money, or slowly add it into your strategies. Now, for instance, I'm what you call a chart pattern trader. Specifically, I trade from support and resistance, triangles, and trends. And I use very simplistic candlesticks and candlestick formations to help me make my final decision. I don't use indicators and oscillators. I'm not saying they're not good. I call indicators the interpreters of the market. If you can't understand what price is trying to tell you, maybe you should use an indicator to interpret that price. But I don't use indicators for entry points. I don't use oscillators for entry or exit points. I might want to use them to confirm a trend. But if I can't see a trend clearly, I don't want to trade it anyway. So some traders make decisions based on price movement of an asset. This is the premise of price action trading. Following the movement of prices and trading it actions they think are the most profitable. Most price action traders don't use technical analysis, such as moving averages or Bollinger Bands. But if they do, you should give them very little weight in your trading decision. A price action trader believes that the only trustworthy source of information comes from the price itself and its movements. So if a stock price begins climbing, it shows that investors are buying because prices rise as traders buy. Then they assess the price action based on the aggressiveness of the buying, the historical charts, the real-time price information, such as bids, offers, volume, and velocity and magnitude. Now, trends or trend lines show us this velocity and magnitude. But we also have indicators like MACD that show us velocity and magnitude of a trade. We could use oscillated indicators like RSI and stochastics. But again, a solid trend line will show you the velocity and the magnitude. In other words, the speed of that movement. So preferred tools for traders are breakouts, candlesticks, and trends. They also use theories such as support and resistance. Traders use these tools and the ideas for developing strategies that work with their preference. So let's go over to some live charts so we don't get too bored here. Okay, so let's take the RSI stochastics off the bottom of this chart because it was just there for a class. And now what we have is an absolutely beautiful chart showing the movement or the price movement of Ripple. Okay. We're not here to discuss Ripple. We're not here to look at a trade or evaluate a trade or potential trade. We're not giving any advice. What I'm showing you are, number one, the red lines are my support and resistance areas. And if you don't understand support and resistance and how to draw them on your chart, you need to come to one of our classes on eyeballing support and resistance. We also have triangle formations. Okay. This old triangle that's long past doesn't do us any good, but we had the new triangle. And what do we get? We got, where I have the star is we got a breakout. Okay. We don't want to predict that breakout until it occurs. Because with price action trading, you're not making predetermined ideas about price. You're waiting for price to tell you what to do. So now you got a beautiful triangle formation. You have a downtrend. You have a breakout of your triangle right at your support and resistance levels. Okay. Now, when you get a breakout, you have a tendency to either move sideways or come back into the apex of the triangle before it starts moving up. Here we had a beautiful breakout, and then we got the sideways action, but still outside the triangle, and then we got a nice uptrend that could have been profitable. But this is simply by looking at price and determining what price is trying to tell us. Now, we might have wanted to go one step farther and added volume to our chart. I don't know why it's not picking up enough high here. But what we want to do is look at volume to confirm our breakout decision. Now, there are many structures that we have or patterns. Like I said, I classify most of everything as triangles. Anytime you have a support and resistance line moving at an angular progress heading into an apex, to me it's a triangle, like when we learned in grammar school. Triangles are just three lines that meet and form a form. Okay. Now, we have very complex traders who want to call them symmetrical and asymmetrical triangles, ascending and descending triangles. They want to call them wedges, pennants, and all these other. Two lines converging in each other, forming an apex with a base. It's a triangle. Okay? Let's make this less complicated. Because here you can see how people make all kinds of complicated things without looking at price. They're getting themselves so locked into what they should be seeing that they never see what price is trying to tell them. Now, keep in mind that yes, on the left, this is a very nice way to see a trend. But in reality, the market is very, 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 very messy. So when we can see a nice, well-defined trend, and believe me, these things do occur, we can then make intelligent decisions. So I limit myself. Now, I might get a lot less trades. In fact, I do, because I don't trade. I mean, I trade and I'm watching and I'm in the market every day. But I only trade when things give me the perfect clues. Support and resistance, triangles, and a beautifully well-defined trend. The more well-defined your trend is, the higher quality your trade will be. This trend can also show you the velocity and the momentum, because we could say that this was an uptrend. Okay, we could. We could say that was an uptrend. But then what we get is we don't have a well-qualified trend, and we don't even have velocity and momentum we can gain. We just see this huge jump in price. Now, there are other types of decisions you can make and other types of ways you can trade. But being able to look at price on your chart and understand what it's saying in relationship to support and resistance in triangles will help you make or the chart patterns will help you make much more qualified decisions. Now, I know a lot of you guys just want to trade. For me, I only want to trade successfully. Now, here we have what could have been a very nice trend. Push, ease, push, ease, push, ease. When we have a trend like that, okay, higher highs, higher lows, lower highs going down. Okay, we can make intelligent decisions because it takes a lot of work for the traders to reverse the trend and then to start pushing up. This is work. This is energy. Okay. So once the traders have invested their energy, you know, it's like a hamster in a cage. It takes them a lot of time to get that wheel turning. But once that wheel gets turning, it just is, and he just runs a mile a minute. Well, that's what happens here. As once the wheel gets turning, more and more traders, more and more velocity is coming, and more momentum is gathering. And in order to stop that wheel, you have to let it slow down. It's not going to stop on a dime. So that's when you will see the end of a trend, or you'll be able to see when momentum is waning. You'll be able to see a change in the trend, and you'll have ample time to exit the markets. Now, these are also all kinds of formations people look for. Head and shoulders, inverse head and shoulders, double tops, triple tops, triple bottom. I don't look for things like triple tops and triple. I don't. Head and shoulders have been around for a very, very long time. But in our type of trading, they take way too long to get developed. So I use falling wedge. Falling wedge, to me, is a triangle. A rising wedge is a triangle. A pennant is a wedge. Consolidation, I don't trade. Channels are virtually the same as a triangle. So support and resistance, trend lines, and chart patterns is one way to trade. I'm not telling you I'm right and you're wrong. I'm not telling you what to do. I'm telling you that if you limit the assets you trade and start to look at price and start to learn what price is trying to tell you and interpreting price, you'll find you will make less trades, but much more qualified, intelligent trades. So they would be more high probability, high profitability trades. So one of the things you want to look for is a breakout. When an asset's price moves within a specific tendency, it alerts traders to a new possible trading opportunity once it breaks that tendency. For example, assume a stock has traded between $11 and $10 for the last 20 days, then moves above $11. This change in tendency alerts traders that the sideways movement has possibly ended and that a possible move to $12 has begun. Breakouts occur from many different patterns, including ranges, triangles, head and shoulders, and flag patterns. A breakout doesn't mean the price will continue in the anticipated direction, and it often doesn't. This is called a false breakout and presents a trading opportunity in the opposite direction of the breakout. Now, breakouts can be small and large. The best way to confirm a breakout is with volume. As price moves into the apex of a triangle or into the center of whatever shape you're looking at, volume will be contracting. This is called the calm before the storm. When it breaks out, you should see a burst of volume. That will support that breakout. If you don't get that burst of volume, then most likely there's nothing supporting that trend. Now, candlesticks are graphic representation on a chart that show the trend, open and close, high and low of an asset. Traders can use candlesticks in various strategies. For example, when using candlestick charts, some traders will use engulfing candlesticks trend strategy. Now, I look for rejection of candlesticks. I'm looking for when price moves up to my support or resistance or inside my pattern, that my candlesticks reject it. And then say, for instance, when it breaks out, I get a close of the candlestick above the pattern. Okay. I and bullish engulfing are about the, or bullish and bearish engulfing are about the only candlestick patterns I use otherwise. And then trends. An asset can be trading throughout the day with prices continue to climb or fall. Traders refer to these fluctuations as bullish trends where the price is rising, or bearish trend where the price is dropping. As many of the decisions associated with price action trading are subjective, what one investor may see as a breakout, another may see as a potential reversal. Compare and contrast this with true technical analysis, where you effectively ignore the experience of investors in favor of cold hard trends. Human nature dictates that futures commodity prices can be extremely volatile. Now, related to the above, traders use price support and price resistance regions to provide good trading opportunities. Support and resistance areas occur where the prices has tended to reverse in the past. Such levels may become relevant again in the future. Now, overbought situations are often created because of the fear and greed with panic. Selling can take over an event of disappointing news. These are types of scenarios where price action investment strategy can prove extremely helpful. Now, there's many different price action strategies you can use. The key to any successful price action trading strategy is to remove the peripheral noise, such as fundamental data and looking at price patterns, and look at price patterns, trends, and other forms of technical analysis. When combined with good old-fashioned experience and a feel for the market, one of the reasons, or one of the best ways to use price action trading, and one of the best to make you the most beneficial trader using price action, is to limit the assets you trade. I mean, tonight we talked about Google for a second. We talked about a stock, another stock for a second. We talked about, I don't even know, but I only trade the euro and euro crosses with majors. That's it. Because I can only track so many assets. I can only look at so many. I can only understand I can talk about Bitcoin right and left. Okay. But I couldn't have predicted that Bitcoin would have gone up to 52 and then fallen back down to 46 because I don't know the personality of Bitcoin. Okay. In order to be able to understand what price is telling you, you have to understand the asset itself, its personality. Like maybe the euro jumps every day at between 9 and 10 and then declines and gives back its losses between 10 and 11. Don't know, except if you're following that asset. So don't forget, even if you have opened a position based on any of the following price action trading strategies, you can use other technical analysis to set your stop loss limits, and don't ever trade without a stop loss. And you can use other pieces of information to decide your entry point, your exit point. You can decide, how much you're going to invest. You can do lots of things. You're not keyed in and locked into just one set of rules. But one of the key aspects of price action trading when using support and resistance levels, the fact that once the support level is breached, it can then turn to resistance or vice versa. The following chart shows how chart analysis can change in a relatively short span of time. So here we see price moving sideways because it's not moving in a trend until we get to here. Okay. Now, what was resistance, because what's resistance? It's stopping the price from moving up. But once price breaks it, it becomes your support level. So here, when price eased down to either make its retracement, whether it was a push and then an ease, or whether it was a reversal, that resistance level became a support level. And what we're looking for is price to hit that and bounce off of and continue its uptrend. So what I teach my students in our support and resistance classes is forget the word support and resistance. Let's just call them price levels. But don't forget, it's only when you take time to understand how bar patterns emerge and what they indicate that you can position your trades. Don't forget, also keep one eye on your stop losses. As you'll gather from the above information, price action trading is based around trends and momentum. The idea is simple. Once a trend changes, then the momentum often grows. It's only when a stronger opposing trend emerges that the direction of the trend changes again. And keep in mind that most of the time the markets are in sideways, choppy action, consolidation phases, or just a mess. You need to find when the market is exhibiting this non-random behavior. So in between these relatively strong trends, there will be periods of consolidation, sideways trading, and price will often bounce off support and resistance lines. In many ways, support and resistance levels are self-fulfilling prophecies. Many traders now use technical analysis to take them into consideration. However, price action trading offers the best of both worlds with both technical analysis and human input from a trader. So don't take any action with a trade until the market itself confirms your opinion. Being a little late in a trade is insurance that your opinion is correct. In other words, don't be an impatient trader. Now keep in mind, one of the biggest disadvantages, you get a very few number of trades. I don't care. I'm busy doing other stuff. I'm always analyzing the markets. I'm always looking at my charts. I'm not rushing to trade. I'm not saying, oh, I have a break. The wife is out. The kids are gone. I got 3 hours. I want to get as many trades as I can. It's not the way to make money. It's not the way to make profit. It's not the way to stay successful in the markets. And you want to wait for these definitive levels. You don't want to push the trade. You don't want to chase the price because there's always opportunities. So many of the strategies you mentioned are overly cautious by some people. When waiting for a definitive change in trend, there may be times when intraday prices could spike above resistance or below support and then recover. These could be false flags and they could be potentially expensive in the long run. And it's one of the few times you don't want to use fundamental analysis, but I always, always, always say you should know what's going on in the world. You should always be looking at your economics calendar and watching the headline because everything could be right. But some statement from the ECB or some statement from the Fed or some economic indicator this release could spike the markets and increase volatility only for a few minutes. Market could go right back to where it was going. But because you had your stop loss so close, you got stopped out of the market because you didn't realize something was going to happen. Or you might have said to yourself, you know what? We have this event at 1 o'clock. I'm not going to even think about opening a trade until 1:30 after the market's gotten past that event. So there's many ways that we can trade. Pin bars and inside bars or mother bars is one of the most common ways. Mother bars and baby bars and inside bars. But that's another class because we have a whole class on mother bars and inside bars. But remember, we want to look at volume, low volume. Volume should be low when price is trading sideways. It should decrease as we're moving to apex and should support your trade when you get the breakout. Now, discipline is necessary because you're going to see lots of trades and have lots of potential, but they don't fit your whole strategy and your emotions will get in the way. So while there is a degree of human input with regards to price action trading, there's also a need to be disciplined, even if you marginally miss out on several trades. The idea is blunt. When the turning point occurs and the momentum builds for a new trend, you can take advantage of it and be there. So remember, the game doesn't start till you open a trade, but once you open it, now you've also put in risk. So for me, the lowest amount of risk with the highest probability trade is what gives me my edge. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. If you have any questions, contact Elvexo and they'll be glad to answer them for you. Bye now.